Good morning, everyone, and thank you for joining us on Morning Markets on Thursday, the 4th of April. Today we'll look at two data points which neatly illustrate some of those challenges that Kevin was discussing yesterday, the strength of growth, but also the backdrop of inflation. So just building on Kevin's points from yesterday, if we look at data from the US in particular yesterday, we saw two things. One, a jobs report, which was better than the market expected, and then an ISM services report, which gave pause for thought in terms of inflation. So let's look at each of those in turn. The employment report, the ADP private sector payrolls, was better than expected, coming in some 34,000 jobs stronger than consensus expectations, but also showing improvement and revisions upward in past months' data. The other element of that report that I thought was really interesting and worth commenting on was what we were seeing in terms of wage changes. If we cast our minds back around 18 months ago, we were seeing rising wages for those changing jobs and a large divergence opening up between those staying and those changing jobs. That was again evident yesterday with inflation or wage inflation for job changers moving up to 10% from 7%, whilst those staying in post it was around 5%. That probably goes some way to illustrating that there is that ongoing resilience in the economic activity in the US, but how tight the employment market remains. We'll certainly get a view on that tomorrow when we have the non-farm payrolls data and the unemployment rate. We then look at the ISM services data. The key point there to take out, we remain in expansion territory as we have for the past 15 months, but obviously slowing as one would expect given that timeline. The key point to take out of that yesterday was the prices paid component, a significant reduction from where it was last month, but more materially taking us back to the levels where we were in March 2020. And those two data points, I think, neatly encapsulate the challenge that we have for markets and for central banks at this point in time, very data dependent. And what do I mean by that? Well, there's two data points there from yesterday. One that would suggest that interest rates could potentially stay higher for longer. The other suggests that inflationary pressures cooling, and then the scope for interest rate reductions becomes more real. This further becomes complicated when you introduce then people's individual perspectives and interpretations of those data points. And certainly over the last week, we've been hearing that in the US with a number of voting members at the Federal Reserve really starting to say growth is strong. Do we actually have to make those 3 interest rate reductions that are indicated? And indeed, one voting member yesterday suggested maybe only 1 reduction would be required. Bringing that all together, it really summarises the view that the market, the Fed, is very much data dependent, moving their decisions from meeting to meeting based on the data that's been seen. And that was very neatly encapsulated by Chairman Powell yesterday when he really said we're moving decisions by meeting by meeting. I'll leave it there for today. I just ask that if you want to join us tomorrow, please do so when we'll review the week in markets, but also look at that very crucial and critical US employment report.